£1. A bank with £5.5 billion in loans, £7 billion in deposits. Annual profit, £88 million. Price tag, £1. Less than a cup of coffee. That is what one bank's ownership sold for. The same week, across the Atlantic, another bank changed hands. $72 billion in assets, sold at a $16.5 billion discount. The acquirer's stock jumped more than 50% in a single day. Both deals closed within a single weekend. Monday morning, new ownership was on the wire. Who was forced to sell? And who was ready to buy? This is a forensic account of where the money moved when a bank collapsed in 48 hours. The bank failed. The money did not disappear. Before March 2023, Silicon Valley Bank was a dam, a $209 billion dam, the 16th largest bank in the United States. Half of all venture-backed tech companies and biotech startups in Silicon Valley ran their finances through this single institution. When a startup raised funding, the money flowed here. When a company prepared to go public, this bank stood in the middle. The entire tech industry was connected to this one dam. Crypto exchanges, biotech startups, Silicon Valley unicorns, all banked here. They shared one thing in common. Every one of them kept deposits far beyond the $250,000 federal insurance limit. As of late 2022, 94% of total deposits at this bank were uninsured, above the protection threshold. More than 9 out of 10 depositors held amounts the government could not protect. That was the hidden fracture inside the dam. In 2020, when the pandemic hit, zero interest rates and unprecedented liquidity flooded into Silicon Valley. Startups raised record rounds of funding. That money flowed directly into this bank's deposit accounts. Deposits nearly doubled in a single year. Total assets surged in parallel. By the end of 2020, the bank held $115.5 billion in assets. By the end of 2022, that figure had reached $211.8 billion. The dam grew too fast. The problem was, where to put all that money? Startups already had enough capital from their funding rounds. Money was pouring in, but loan demand was not keeping pace. SVB parked those deposits into long-term government bonds and long-term mortgage-backed securities. By end of 2022, the investment bond portfolio stood at $120.1 billion, more than half the bank's total assets. At this point, SVB was less a commercial bank and more a giant bond fund borrowing short to invest long. The problem was that this structure was catastrophically vulnerable to rising rates. When interest rates rise, bond prices fall. In 2022, the Federal Reserve raised its benchmark rate from 0 to above 5%. Losses began mounting rapidly inside SVB's books. But those losses did not surface immediately. The bank had classified most of its bonds as held to maturity. Under this accounting category, falling market prices did not need to be reflected immediately on the books. By end of 2022, the unrealized losses hidden inside that category totaled $15.2 billion, almost equal to the bank's entire equity capital of $16 billion. From the outside, everything looked fine. That was precisely what made it dangerous. At the same time, deposits began to drain. As startups struggled to raise new funding, they started withdrawing their cash to cover operating costs. Deposits fell from $189.2 billion in 2021 to $173 billion by end of 2022. The flow had reversed. The bank needed liquidity. It had to sell bonds it had classified as held to maturity. And the moment it sold, those hidden losses became real. Wednesday, March 8, 2023. SVB's parent company announced it had sold $21 billion in bonds. After-tax loss, $1.8 billion. And to plug that hole, it would raise $2.25 billion in emergency capital. Management called it sound balance sheet management. The market read it differently. What had been hidden was now visible. A liquidity crisis, not a health check. Morning of March 9th. Venture investors in Silicon Valley made their move. They sent a single sentence to their portfolio companies: "Get your money out. Now." That message traveled through Slack, spread on WhatsApp, went public on Twitter. There was no line at the teller window. Billions of dollars moved simultaneously on smartphone screens. This was a 21st century bank run. Thousands of customers, all connected in the same network, all running in the same direction at the same moment. $42 billion left in a single day. That matched the entire annual GDP of Iceland. Not over a year, in one day. By evening, management reported to regulators. Another $100 billion in withdrawal requests was queued for the following day. Through the night, they scrambled for funding. Nothing worked. Friday morning, March 10th. California's financial regulator shut the bank. The FDIC was appointed receiver. At that moment, SVB's cash balance was negative $958 million. The bank owed nearly $1 billion more than it held in cash. The dam had not cracked. The dam was gone. Friday morning's account freeze instantly spread into the real economy. March 15th was one of the key payroll dates for U.S. companies. For direct deposits to reach employees' accounts on time, fund transfers had to begin days in advance. For thousands of startups using SVB as their primary bank, that process stopped. The FDIC's $250,000 protection limit did not cover even a month's office rent for most of them. The CEO of a leading Silicon Valley startup accelerator called this an extinction-level event. "Without payroll, you cannot keep people working," he said. Thousands of startups could go under. A healthcare startup CEO in Seattle said, "I need clarity. Every hour of uncertainty makes it worse." One founder who managed to withdraw funds in time described the moment. "After the transfer confirmed, my body was shaking with relief. The weight of the crisis, invisible in any spreadsheet, was contained in that trembling." Before Saturday, another domino had already fallen. On the same day, March 10th, regulators also shut Signature Bank. It was a bank with heavy exposure to crypto-linked deposits. The moment SVB's shadow reached it, depositors moved. The digital bank run was contagious. The speed was incomparable to 2008. Over the weekend, Washington moved. The Treasury, the Federal Reserve, and the FDIC gathered in the same room. Their judgment: if uninsured depositors lost their money, other banks would not survive Monday. Sunday evening, March 12th. The three agencies issued a joint statement. Inside the Federal Deposit Insurance Act, there is a systemic risk exception, the authority to protect all deposits beyond the limit when the entire system is judged to be at risk. That night, the exception was invoked. Every depositor at SVB and Signature Bank would be made whole, even above the $250,000 limit. Shareholders were different. So was management. Their equity was wiped out entirely. Unsecured creditors shared the same fate. The government saved the depositors. It did not save the owners. Who paid for this? The FDIC estimated the cost of resolving SVB at approximately $16.1 billion. That loss was billed to surviving U.S. banks as a special assessment. The decisions made by SVB's management had transferred a cost to the entire banking industry. The losses were socialized. But that was not the end of this crisis. The real transfer was only beginning. Monday morning, March 13th. Across the Atlantic, the Bank of England was already in motion. SVB had a UK subsidiary, £5.5 billion in loans, £7 billion in deposits, a profitable bank, and the primary financial institution for British tech startups. The Bank of England invoked its stabilization power, the authority to legally transfer all shares of SVB UK. The acquirer was HSBC. The price? £1. Based on tangible capital alone, SVB UK was worth more than £1.4 billion. That ownership transferred for £1. Early Monday morning, March 13, 2023. Why did HSBC accept this deal? In a single move, they secured the core customer base of the UK tech finance market. SVB UK's network of startups and venture relationships was a relationship asset that money alone could not buy. £1 was the price of that access. But the market read it differently. HSBC shares fell more than 4% immediately after the announcement. The judgment. They had also acquired the tech sector's downside risk. The cheapest price tag almost always carries the largest uncertainty. £1 was no exception. In the United States, the real competition was just beginning. The FDIC needed a buyer for SVB's remaining assets. Apollo, Blackstone, Carlyle, KKR, the largest private equity firms entered the bidding. They wanted assets priced by crisis. 18 bidders assembled, 27 bids came in. Sunday, March 26th, the FDIC announced the winner. It was not a major private equity firm. The winner was a family-run bank headquartered in Raleigh, North Carolina. Founded in 1898, First Citizens Bank Shares. From the FDIC-managed SVB Bridge Bank, First Citizens acquired the full deposit base and $72 billion in loans, at a discount of $16.5 billion. A $72 billion asset portfolio had changed hands at a 23% haircut. That was the only way the deal could close. On the day of the announcement, First Citizens stock jumped more than 50%. The market immediately understood the value of the deal. When the first quarter results came in, the numbers confirmed it. First Citizens recorded a special gain of $9.82 billion in Q1 2023 alone. The fair value of the assets they acquired was substantially higher than what they had paid. One transaction, in one quarter, translated into an enormous profit. There was another set of books on the other side. The FDIC absorbed a loss of approximately $16.1 billion on this transaction. One side's gain, the other side's loss. Two ledgers, same deal. Crisis transactions always produce two sets of books. Fear collapses prices. Those who understand the structure collect gains from those collapsed prices. Why First Citizens? This bank had more than 2 decades of history acquiring failed banks alongside the FDIC. Built through dozens of insolvent bank acquisitions after the 2008 financial crisis. The capability to complete due diligence fast and make decisions fast. The FDIC was not looking at price alone. They needed a trustworthy partner, an acquirer capable of stabilizing the system under conditions of deep uncertainty. Private equity firms wanted to buy assets. First Citizens committed to continue operating the bank. That distinction decided who won the bid. But was this deal a complete victory? After the acquisition, reality began to reveal itself. At the time of the deal, SVB held approximately $212 billion in deposits. The customers left. Within less than a year, deposits had fallen to around $40 billion. 80% of the original deposits had vanished. The same story played out with people. 42 of SVB's key bankers left for HSBC, taking their client relationships with them. Litigation followed. The bank had been acquired at a historic discount, but holding on to the relationships and the people inside that bank was an entirely different problem. First Citizens did not win this deal because they were brilliant. 3 things aligned: a long-standing trust relationship with the FDIC, a track record in failed bank acquisitions, and timing. Structure creates opportunity, but opportunity always carries a price tag that is not visible at signing. This crisis crossed the Atlantic. In Europe, Credit Suisse was already faltering. On March 19th, UBS acquired Credit Suisse under Swiss government mediation for 3 billion Swiss francs, less than 1/10 of its book value. The same pattern repeated on a different continent. Crisis spread. Assets moved at distressed prices. After SVB's collapse, the U.S. venture finance ecosystem quietly reorganized. Startups stopped keeping all their cash in a single bank. The large banks absorbed the tech sector's clients, and a vacuum appeared. The venture lending market, SVB, had dominated. The space where startups could borrow without collateral was now empty. Private credit funds, Apollo, Blackstone, moved in to fill that space. Private capital replaced the bank that had left. The cost of access went up. For smaller startups, raising capital became harder. This was the quietest but most lasting consequence of SVB's collapse. When the dam disappeared, the river changed course, and building a new channel cost far more than the dam ever had. The Fed launched an internal review immediately after. The question: what were supervisors doing while SVB deteriorated to this point? The Fed's post-mortem report was unambiguous. Supervisors failed to keep pace with SVB's rapid growth. They saw the risks, but did not force corrective action. Regulatory rollbacks had widened the gaps. The failure was not only inside the bank, it was inside oversight and the rules themselves. There is a more dangerous shift this crisis revealed. The 2008 bank run looked different. Lines formed at branches. Photos ran on front pages. People gathered outside doors before dawn. In the most significant bank failure of 2008, Washington Mutual, it took roughly 16 days for deposits to fully drain. The 2023 bank run had none of those scenes. It happened on smartphone screens. One Slack message spread, and within 24 hours, tens of billions of dollars had moved. SVB's deposits drained in 48 hours. A digital bank run gives regulators no time to intervene. Speed itself outpaces the system's defenses, and that speed will only accelerate, never slow. Where a dam collapses, a new channel forms. Where SVB once stood, assets moved. First Citizens took $72 billion in loan assets, at a $16.5 billion discount. HSBC took the UK piece for £1. Private capital filled the empty ground. While the losers' assets shifted onto the winners' balance sheets, thousands of startups held their breath for 48 hours. What crisis reveals is one thing: who was prepared and who was forced to sell. While fear governed the market, those who understood the structure made their move. A structure that forced a $16.5 billion discount was already in place. Those who were ready moved inside that structure. This is not only SVB's story. Every time a crisis arrives, ownership transfers, always in the same direction. The assets of those who broke first flow to those who moved last. Now the question turns toward us. Can we withdraw every dollar from our bank within 48 hours? How quickly can the assets inside that bank convert to cash when a crisis hits? This is not a question born of fear. This is a question of structure. A dam always looks intact, until the moment it does not. No one knows where the next dam will crack, but in that moment, who will be forced to sell, and who will take the gain? Is that not already decided? Which side we are on is something we can choose right now.